a sell-off in the fourth quarter. Complacency was pretty high going into the fourth quarter, but now stocks are back higher than where they were before the end of the quarter. In fact, stocks are at all-time highs. And what's really changed on the upside, right? We've got a Fed that's more dovish, for sure, but they're dovish because they're worried. But yet growth expectations around the world and in the US are coming down. The two things that are worse for markets are complacency and uncertainty. So I'd argue that complacency is pretty high still right now, and uncertainty, whether it's to do with Brexit or trade negotiations, is still high. We've seen some volatility in the last couple of weeks, but volatility in itself is volatile. So we should be cautious about where we go from now on. Investors are faced with information overload. Information and data is being thrown at them, and there's a lot of noise in the marketplace, which is causing investors to stray away from their disciplined investment approach over a longer period of time. One of the questions I love to ask audiences is, consider an investor that wants a 10% return from point A to point B. They're locked in a room. They don't have access to any information or noise. They can't speak to their friends and neighbors. They have three investment choices. The first is a risky asset class, maybe the S&P 500. The second is a multi-asset approach, maybe a 60-40 type of portfolio. The third is cash. Over that time period, doesn't matter how long it is, this is hypothetical, the 10% goal is reached in all three of those investment choices. So the question I always like to pose is, which should the investor pick? The risky asset class may have doubled in value, sold off, but got to the 10% goal. The multi-asset approach, kind of like, didn't have the ups, but it didn't have the downs, but still got you to the 10% with a smoother ride, and cash just incrementally getting you to 10%. So which is the correct investment? And most people get it wrong when I ask them. They tend to pick cash. The correct answer is that all three of them give you the same result. The investor doesn't have access to any information, so they're unaware of the volatility, which is really describes the journey from point A to point B. In reality, investors do look at their statements, they do compare themselves to the market. So if you're in the S&P 500, you doubled your assets, you feel pretty good. Multi-asset and cash up until that point doesn't feel that great. When the market sells off, multi-asset and cash actually looks a lot better. So multi-asset in that context could be something that makes a lot of sense to an investor. Well, I think phrases like fear of missing out, with the bull market that we've had in equities, a lot of people have felt that they missed out. And in some cases, those people that weren't allocated to the market may want to try and catch up. And in some cases, the people that were in the market that experienced a sell-off are basically have an emotional response. So there's a couple of behavioral finance traits. Overconfidence is certainly one of them. Maybe they've made some trades in the past that have made the money. Maybe they're looking to get back in and try to repeat those same things. Loss aversion as well. So the fear, the actual the feeling that you get when you lose money is about twice as powerful as gains. We've done some analysis that really looks at what an investor actually experiences versus a buy and hold strategy. And what we saw over the last 12 months, so taking into account the fourth quarter as well, was that more volatile asset classes actually had investor returns that were significantly less than what you would have had when you were a buy and hold investor. So that really tells us that in the fourth quarter, when volatility picked up, those single asset classes that kind of sold off the most had the worst outcomes for investors. And we see this behavior over a longer period of time as well. Going back to 2008, every single year, the majority of asset classes that we looked at had investor returns that were worse than the actual buy and hold strategy. And in four of those years back to 2008, 100% of the asset classes that we looked at lagged the market. So that tells us that people are moving in and out intra-year, and remember, these are longer term investments, and even allocation funds where they are supposed to be for a longer period of time, many investors are not using those correctly either. I think first of all, mitigate risk. Look at the asset mix that you've got right now. Think about those long-term goals and how are you going to get there. Ignoring the noise in the marketplace. There will be volatility, and I think the market is starting to crack right now. I think we are at this inflection point right now between a long-term bull market in equities and potentially some volatility. Consider multi-asset as well. Multi-asset vehicles are designed to lag the market in strong up markets, but they should protect on the downsides in more volatile periods of time. So holistically, work with your financial advisor, get the allocations correct, and then stay the course and try to ignore the noise in the marketplace. I think the second half of this year, markets are going to be a little choppy. We've got a lot of uncertainty and we've got complacency in the markets right now. So this would cause me to want to position our clients' assets to be more conservative in nature. So risk off, certainly underweight equities, picking up some of the carry. We are in a more dovish interest rate environment right now, so the prospect of rates moving higher is probably diminished from where we were in the fourth quarter when many people think the Fed made a policy mistake. So taking the carry on the fixed income side, but underweight equities, and consider the use of alternatives to minimize the volatility over time.